Hello, this is Becky C. The article that I'm talking about today is called Are Student Loans Becoming a Macroeconomic Issue? It was published on April 23rd, 2013 by Mike Konskawal. And as we know, as we've learned in class, more general and larger part of the economy is called macroeconomics rather than a more specialized and smaller part, which would be microeconomics. So right now, they're saying that student loans would be considered only a small specialized part, but perhaps that their effects may become an effect towards the larger part of the economy. And the general economic consensus of the impact of student loans on household finances of those who hold them was what they were addressing in this article. There was an article that they referenced inside the article that I wrote called Student Loans, Do College Students Borrow Too Much or Not Enough? And it argues that there's little evidence to suggest that the average burden of a student loan repayment is relative to the income that it has increased in recent years. And that used data from all the way from 2004 to 2009 to collect. And the author finds that the mean ratio of the monthly payment to income is 10.5% for those in repayment 6 years after the initial enrollment. But some may ask how it could not change even though the economy has changed so much, how that it's not really becoming a burden even though our income, even though our loans have increased so much, how could it not be affecting us? Well, it would be caused by the rising debt, but it is also compensated by the steady income that you now have because of your schooling. So it kind of balances out, and it can also be attributed to a combination of the rising earnings, the declining interest rates because the government is trying to encourage us to spend since our economy isn't at the best standings right now, and the increased use of extended repayment methods. This is how the total average of as I quote from the passage, the total average undergraduate debt jumped from 65% of a value of $18,900 from 1997 to 2002, and the average monthly payments increased by only 13% over these 5 years. So the mean ratio of the payment to income actually declined from 11% to 9% because of the borrower. But that was obviously only from 2002. More recent knowledge, as I read further in the passage, more recent knowledge shows that over the past decade, people with students' loans were more likely to have a mortgage at age 30 and a car loan at age 25 and more financial hardships. When people thought that student loans were not that big of an issue, and that they would get paid off because you'd have a higher income, that was when the economy wasn't in a time of crisis. So it didn't examine the effects of student loans when the economy was down. But now we can see, as our economy isn't the best right now, it's a little rough, that student loans have a greater impact because if you're already struggling to make your bills when you don't have student loans, it's going to be more of an issue for you to now support yourself, or if you have a family, support food, your housing, and now you have these extra payments on top of it. Whereas before, maybe it wasn't an issue for them to make their food bills and their housing bills, but now they have just another burden on it. So this article the overall gist of it didn't really necessarily give a straightforward answer if student loans were becoming a macroeconomic issue or not, but it presented evidence to support that the category is influenced by the current status of the economy as to how much that it is affected. And this makes sense because, as I said, people, if the economy's down, they're going to have more of a hard time, so it may become a macroeconomic issue, whereas if it's not that big of a problem, it will stay a minor, more specialized issue. And that was just a very brief article, a brief summary of my article. If you have any questions, please let me know. Thank you.